Welcome to today's video. If you want to learn how to start investing and build your wealth, stick around to the end of the video. Today I will teach you the fundamentals to stock market investing, how to start, where to start, and why you should invest in the first place. As a quick disclaimer, I wanted to let you know that this is not financial advice. This video is for educational and entertainment purposes only. So with that said, click the subscribe button below and let's get started with the video. MJ DeMarco's book, The Millionaire Fastlane, is a book about how someone can get rich quick through business and investing. A common misconception I want to clear up is that getting rich quick is not a scam. Anytime you hear the term get rich quick, it is commonly associated with someone trying to scam you with some online course. What is a scam is getting rich easy, but it is possible to get rich quick. And quick in these circumstances is within about 10 years. So, there are 3 lanes people can take in life. The fast lane, which is when you start your own business, the slow lane, where you invest in other people's businesses, or the sidewalk, where you do nothing but save little money or live paycheck to paycheck. Starting a business is not easy, nor is it for everyone. So I'm going to show you how you can get rich with the slow lane. Investing is the commitment of resources to achieve later benefits. If an investment involves money, like the case we are talking about today, investing is a commitment of money to receive money later on. When you start investing, you have unlocked your potential to grow exponential wealth. You have breached the point where you are no longer trading your time for money, and that is key if you want to get ahead. If you look at the list of the richest people in the world, as you can see here, all of them have either started a business or own a business. So this tells us that we need to get our hands on a business. And there are 2 ways to do this. You can either start your own business or you can invest in someone else's business through the stock market. The stock market is a tool we can use to start investing in businesses in the form of stocks or shares, which are essentially the same thing. They are small little part ownerships of businesses. You should think of stocks in that manner, not as little numbers that bob up and down. So when you are a shareholder, what you actually are is a part owner of that business. The more shares you own, the larger your part ownership of that business is. You can buy shares in companies that are publicly traded. So examples of this include Costco, Google, Woolworths, Apple, and Meta, which was formerly known as Facebook. When people start investing, there are 2 types of investing methods you can do. There is passive investing and active investing. Active investing is when you selectively choose which stocks you want to invest in, whereas passive investing is more of a set it and forget it kind of style, because you can set up recurring investments. When you invest passively, you buy an ETF, which stands for Exchange Traded Fund, or an index fund that tracks the market or a particular index. This is just buying a big group of stocks and having your money divided amongst all those stocks. Think of buying an ETF as a basket of stock, and its one stock can represent 200 or so companies, sometimes more, sometimes less, depending on the indice you're tracking. So let us compare ETFs, index funds, and active investing. Index funds have low management fees. They outperform actively managed funds over the long term and have lower risk due to their large diversity. Negatives of index fund include a higher barrier to entry. They typically require $2,000 to $3,000 to get started, sometimes even more, which makes it more difficult for a beginner investor who is just starting. When you hold an index fund, you also have no control over the companies in the fund, meaning you can't pick and choose which companies you want in, which therefore leaves you no strategy variation. ETFs, however, can give you access to many different stocks in different indices too. They have a lower barrier to entry and you can get started with as little as $60, and they are very liquid, meaning you can buy and sell them whenever you want while the market is open and easily turn them into cash. However, the downsides almost resemble index funds, because you also have no control over the holdings, and some ETFs that are actively managed can have higher fees. Now, lastly, we have active investing. This is a method where you can outperform the market through implementing your own strategy. However, it is very difficult to do and risky. Most people fail to outperform the market in the long run. Now, remember, you are not obliged to do one or the other. You can mix it up, like I personally do. Most of my holdings are active positions, while I have a small select few passive investments through ETFs. If you want to be an active investor, it does require a lot more work. It requires you being able to do stock research, analysis, and due diligence, which also includes you keeping up with the companies you are invested in. So it is a more hands-on approach compared to passive investing. But however, Warren Buffett recommends for the average person to just buy an index fund, an ETF, because it's the easiest way to invest for most people.
Some of the things that really resonated with people, and maybe start where you began the annual meeting this year, and that was talking to your investors and telling them a little bit about investing, some tips and lessons along the way. You kind of used it as a teaching experience at the top.
Yeah, normally I don't do that. I mean, in fact, I can't remember when I did it. We just go right into questions and answers. But I really thought that maybe we were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it'd amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
How and where can I get started today? Investing today is so much easier than it used to be decades ago. 25 years ago, you had to go to a stockbroker and pay him a commission to buy shares for you on your behalf. But today, this can all be done online through brokerage apps. These apps include Stake, eToro, Comsec, Superhero, NabTrade, SelfWealth, or Tiger Brokers. The one you choose depends on your location and where you want to invest your money. Me personally, I use Stake because it's a platform where I can buy Australian and US listed companies. There are other brokerage apps that can allow you to do that as well, and apps that offer so many different international stocks in different exchanges. Also be aware that these different brokerage apps also have different fees and commissions attached to each of them. So it just all depends on what your personal preference is and which countries you would like to invest your money in. So, how do you make money from the stock market? There are 2 ways you can make money in the market, through either dividends or capital gains. Dividends is the money you get paid by the company for holding their stock, and it is calculated based off a dividend yield. The dividend yield represents the percentage of the company's share price it will pay out in the form of dividends. So, if a company has a share price of $100 and a 5% per annum dividend yield, it will pay you $5 per share in total for the year. Dividends can be paid semi-annually or quarterly, and remember, they are taxed. Dividend yields can range from being lower than 1% to as high as over 10%. However, most stocks have a healthy and maintainable yield of about 2 to 5% per annum. A lot of people can get trapped by the dividend, where they go into a stock just because it pays a high dividend, but that company may not be able to sustain that yield, or the stock price could be going down and you are actually making a loss. So always remember, a very high yield can be a negative sign, not a positive, and the company is not obliged to pay you a dividend. It can cancel it at any time. If you are interested in dividends and want a company that consistently pays them, you can check the company's dividend track record, where it can show you how long the company has consistently been paying the dividends and whether it's growing every year or not. There are companies labeled as dividend aristocrats, which are when a company has been consistently paying their dividend and also increasing it for over 25 years. Now, the other way to make money in the market is through capital gains. This is when the value of your stock increases from the time you bought them. So if you bought a stock at $100 and now it's worth $150, you have made $50 in capital gains, which you can't use unless you sell the stock. So this isn't cash flow like dividends, but it's profit on paper. The benefit of capital gains is that they can't be taxed until you realize the capital gain by selling your holding. And if you have held the asset for more than 1 year, they can only tax you up to 50% of your capital gains. So, in the example we talked about before, we made $50 in capital gains profit. You can only be taxed for the $25, not the full $50, because you have held the asset for more than 1 year. So, the total return of a stock is calculated based off its capital gains plus the dividends if it pays any dividends. So I know after all we have learned so far, you are very keen to get started with investing. However, before you do, there are some key fundamentals you must know and some risks you must be aware of. What you first must know is that the stock market can be risky. You can lose money if you sell at a loss. Not every company will be a winner, and know that in some years your portfolio can go down. Despite the long-term average return being around 10%, it doesn't mean that every year your portfolio will make 10%. Some years it can be more and some years it can be less. And that all depends on your holdings too. Also note, the stock market going down is completely normal. A bear market is when the market falls 20% from its high. And since 1945, there have been 15 bear markets, which means there is one every 5.1 years. So being aware of this helps a lot. You shouldn't panic because the market always recovers. We have been through 2 world wars, the Vietnam War, Cold War, nuclear bombings, pandemics, epidemics, natural disasters, and major political events. We have been through times that made people think it's the end of the world. However, the stock market has still performed and made countless people rich. So don't get easily scared out of the market. The next thing is to make sure you have an emergency fund settled before you get started. This fund should cover about 3 to 6 months worth of expenses. However, if you have a job where your income is not as consistent, like a sales job, or where your income varies, it is recommended to have about 6 to 12 months worth of expenses saved up before you start investing. And remember, investing is a long-term game. It's not designed to make you rich in the next 6 months or 1 year. It has the best results over the long-term horizons like 5, 10, 15, or 20 years. So don't invest any money you may need in the next 2 to 3 years, because you're not giving your money that opportunity to grow, because it's a long-term game. It's a slow and steady way of getting rich, like we discussed before, the slow lane. So I hope this video has been a help to you. We covered the philosophy of investing, why you should invest in the stock market, and what it is. We also covered the different types of investing through active and passive investing, along with their pros and cons. I then gave some examples of brokers you can use to buy equities in, and then we closed off the video by learning how you can make money in the stock market, along with the risks and fundamentals you should be aware of. Please remember, again, that investing is a long-term game. It's not meant to make you rich in the next 6 months. or the next year, but over the long term, 7+ years. So that's all for today, guys. Thank you guys for watching. If you enjoyed the video, share it with a friend. If you would like to see more videos like this, smash the like button and subscribe to my channel, as I will have more content out soon. If you have any questions or suggestions, feel free to drop a comment below. And thank you guys for watching.